The moment you decide what the market must do next, you begin editing what it is doing now. A weak rally starts to look like confirmation. A failed breakout becomes a temporary delay. A growing loss feels easier to defend because your prediction has quietly become more important than the evidence. That is the hidden cost of guessing. It does not merely produce wrong forecasts. It changes the way you see. Once you become attached to a direction, you stop reading price as information and start treating it as an argument. Every movement against you demands an explanation. Every movement in your favor appears to prove your judgment. The market has no obligation to complete the pattern you recognize, honor the story you believe, or move on the schedule you prefer. It reveals itself through behavior, whether price can hold above a breakout, whether buyers continue after an advance, whether selling is absorbed or allowed to accelerate. These observations are less exciting than predicting the next move, but they are far more useful. Consider a hypothetical breakout. Price pushes above resistance, and you buy because the move appears strong. What matters next is not your original reasoning. What matters is the market's response. Does price remain above the level? Do pullbacks become shallow? Does progress continue without repeated rejection? If not, the breakout may be exposing trapped buyers rather than the beginning of a sustained advance. The guessing trader explains away that failure. The observing trader records it. This difference affects every practical decision. When you predict, you are tempted to enter early, add because the price is better, widen a stop to give the idea more time, or remain in a motionless position while stronger opportunities develop elsewhere. Because follows belief, the stronger your attachment to the forecast, the more evidence you must ignore to preserve it. So begin noticing the language of your own decisions. It has to reverse. It cannot go much lower. It should reach my target. Those phrases may sound like analysis, but they often reveal negotiation. The market is not negotiating with you. Replace certainty with conditions. Instead of saying, "This will rise," define what rising behavior would actually look like. Identify the level that must hold, the response that should follow, and the behavior that would invalidate the idea. Then watch. You are not demanding that price obey your conclusion. You are requiring price to earn your commitment. This does not remove uncertainty. Nothing honest can. It changes your relationship with uncertainty, from something you try to defeat with prediction into something you manage through evidence, timing, and risk. But there is a deeper difficulty here. Even after a trader understands that guessing is costly, the mind continues searching for certainty in subtler forms, and those forms are often mistaken for discipline. To recognize them, you must first examine what you are truly doing in the moments before you enter. A forecast begins shaping your attention before the market has a chance to present the full picture. If you expect strength, your eye settles on firm closes and quick recoveries. Quiet distribution, shrinking participation, and repeated hesitation remain visible, yet they receive less weight. Nothing has been hidden from you. Your expectation has simply decided what deserves notice. This is why selective vision is difficult to detect. You are still looking at the chart. You are still reading news, comparing levels, and following each change in price. The error is not a lack of information. It is the unequal treatment of information. The mind prefers a complete story. Once it chooses one, uncertain details are sorted into useful and inconvenient categories. Useful details are remembered clearly. Inconvenient details are softened, renamed, or postponed. A weak close becomes normal profit-taking. An unexpected surge in selling becomes temporary noise. The description changes because the forecast must remain undisturbed. Time frames can become part of the same habit. When the short-term chart challenges your view, you move to a longer one. When the longer chart offers no support, you search for a smaller pattern. Each change may appear analytical, but the sequence reveals the purpose. You are no longer selecting the time frame that fits the trade. You are selecting the view that protects the forecast. The same distortion appears when you collect analysis. You read one opinion that disagrees with you and dismiss it quickly. Then you find 3 that agree and study them carefully. What are you researching at that point? The market or reassurance? The amount of information increases, but your understanding does not, because every source passes through the same filter. This has a serious implication. A trader can work hard, remain attentive, and still become less informed with every hour of analysis. More charts do not correct a biased lens. More indicators may only provide more material from which to select agreement. Effort strengthens the error when the method of observation remains unchanged. You can test this tendency by separating description from interpretation. Before naming the market bullish, bearish, strong, or weak, describe what is present in plain language. Note where trading activity is concentrated, how long price remains in an area, which movements attract participation, and which movements fade. Do not explain these facts yet. Explanation added too early gives preference a place to hide. Then examine the words in your notes. Remove phrases such as probably, should, and looks ready. Replace them with statements another observer could verify from the same chart. This does not make your reading perfect. It makes the influence of your forecast easier to see. A second exercise is to review the same chart without your original annotations. Cover the symbol, hide your entry if possible, and begin from a point before your opinion was formed. Notice where your attention goes now. Details that seem obvious in review were often present in real time. They were simply denied importance because they did not fit the chosen picture. The discipline begins with learning to see without immediately arranging every fact around a prediction. Once that lens becomes clearer, a more demanding question comes forward. If your opinion is no longer allowed to lead, what evidence should? A market can receive favorable news and still decline. It can absorb a disturbing report and continue higher. The opinion may appear sound, the reasoning may be careful, and yet the price moves the other way. That contradiction is not meaningless. It is often the clearest information available. An opinion describes what you believe ought to happen. Price behavior records what participants are actually willing to do with their money. The first is an interpretation. The second is a consequence. When the two disagree, the consequence deserves your attention. This matters because information does not move a market by itself. A market moves when orders arrive with enough force to overcome the orders on the other side. A convincing story may attract interest, but if that interest cannot lift the price, then supply is meeting it. The headline explains the reason people might buy. The tape reveals whether their buying has power. Suppose a company reports better results than expected. The stock opens higher, trades actively, but gains little ground through the session. The important fact is not that buyers appeared. The higher opening already tells you that. The important fact is that continued buying produced little additional progress. When effort brings a small result, resistance is present, even if its source cannot be seen. Now consider the opposite response. A weak report reaches the market, selling appears, yet price gives up very little ground. The sellers have a reason to act, but their pressure does not produce the expected distance. That behavior tells you something the report cannot. Other participants are willing to receive the supply. The speed of movement adds another layer. A slow advance built from repeated pauses is different from a sharp rise that holds its ground. A decline that travels freely carries a different message from one that requires constant selling to move a small distance. Distance tells you what changed. Ease tells you how much opposition stood in the way. Duration matters as well. A brief reaction may reflect emotion, automatic orders, or thin liquidity. Sustained behavior shows that participants continue making the same choice after the first response has passed. The longer that choice persists, the less weight you should give to explanations that describe the move as accidental. This is where intelligent traders often become confused. Their reasoning may be fundamentally correct, but the market may not be expressing that reasoning now. A sound economic argument can remain sound while the trade built upon it performs poorly. Analysis and market expression are not the same event. To read behavior more clearly, observe three things after meaningful information enters the market: how far price moves, how easily it travels, and how much of that movement remains after the first reaction settles. These are simple measurements, but together they reveal whether participation is producing a lasting result. Keep your language factual. Instead of writing, the news was strong, so the stock is bullish. Record. The stock opened higher, advanced only slightly, and closed near the opening. One statement protects an interpretation. The other preserves the behavior for examination. Once you begin giving greater authority to what capital is doing than to what commentary is saying, another problem appears. How much evidence should the market provide before your own capital has any reason to follow? A promising setup can make you feel as though the market already owes you a result. The chart is clean, the theme is understandable, and the opportunity appears obvious. Yet none of those qualities has earned full commitment. They have earned attention. Commitment is more than placing an order. It includes capital, time, and mental concentration. The moment all three are devoted to an unproven idea, your flexibility decreases. You have treated a possibility as though it has already matured into an opportunity. Evidence comes in degrees. A recognizable structure may justify watching. The beginning of movement may justify limited participation. Continued progress may justify greater involvement. These are separate achievements, and the market should not receive credit for one before producing it. This is why commitment does not need to be a single decision. It can be granted in stages. A trader who commits everything at once has no meaningful response when the picture improves. The decision has already been made. A trader who commits gradually can let developing evidence determine whether involvement should remain modest or become more serious. The purpose of a small initial position is not to predict with less money. It is to place the idea under examination. Once you are involved, the trade reveals qualities that were difficult to judge from the sidelines. Does it make progress without requiring constant defense? Does it behave cleanly during ordinary pressure? Does it begin separating itself from the area where uncertainty was greatest? A trade earns further commitment when it reduces the number of explanations required to hold it. Healthy progress is usually understandable. Price acts in a manner consistent with the original premise, and the position begins to support itself. When every session demands a new interpretation, the trade is asking for loyalty it has not earned. There is also a difference between being involved and being committed. You may hold a position while remaining mentally free to evaluate it. Trouble begins when ownership becomes allegiance. Then ordinary participation turns into a private obligation to make the trade succeed. To prevent that shift, ask a narrow question after entry. What has this position done since I became involved to deserve my continued attention? The question is not whether the original setup was attractive. That decision belongs to the past. The question is whether the trade has added anything to its case. A useful record can make this visible. Note what first earned your attention, what later justified participation, and what subsequent development justified any deeper commitment. If the same observation appears at every stage, no new evidence was added. Your exposure increased, but the trade's case did not. This method places responsibility where it belongs. You are responsible for deciding how much commitment each stage deserves. The market is responsible for supplying the evidence. One should not be advanced merely because you hope the other will follow. But apparent evidence can be misleading. A move may seem to earn commitment, attract participation, and then lose its character with surprising speed. What that sudden change reveals is the next matter to examine. The most revealing movement is sometimes the one the market cannot complete. Price begins in one direction, draws attention, and appears to open a clear path. Then the advance or decline loses its footing. What looked like strength becomes evidence of resistance from the other side. A failed move is not merely a turn. It is an attempted expansion that cannot remain outside the area it was trying to leave. The attempt matters because it tests available orders. The return matters because it shows which side controlled the test. Consider a hypothetical market pressing below a well-watched low. Selling accelerates as the level gives way. New sellers enter, protective orders are triggered, and price reaches territory that should favor further decline. Yet the market cannot remain there. It rises back through the broken area and begins holding above it. That recovery reveals pressure that was difficult to see beforehand. Buyers did not need to advertise their interest while price was above the low. Their presence became visible only when aggressive selling reached them and failed to produce lasting displacement. The sellers supplied the test. The buyers supplied the answer. The return can gain force for another reason. Traders who sold beneath the low now hold positions that depend on continued weakness. When price recovers, some of them must buy back. Their exit orders join the demand already present. A failed decline can therefore create buying pressure from both interested buyers and retreating sellers. The amount of effort behind the original attempt affects the meaning of its failure. A shallow probe, rejected on light activity, may reveal little. A forceful move that attracts heavy participation and still cannot remain beyond the boundary says more. Greater effort followed by rejection exposes stronger opposition. Speed also carries information. A slow drift back may show uncertainty. A quick return suggests that the market found little acceptance in the new area. If price then remains near the old range instead of immediately retesting the extreme, the rejection has begun changing the local balance. You should distinguish failure from an ordinary pause. A market can rest after moving without surrendering the ground it gained. Failure becomes more credible when price returns through the point where the attempt began, spends time back inside the prior area, and shows little ability to recover the lost territory. To study this clearly, mark the origin of the move before judging its outcome. Then note how far price traveled beyond the boundary, how long it stayed there, and how directly it returned. These observations reveal whether the market explored new ground or was firmly refused. A failed move is not an automatic command to trade in the opposite direction. It is a change in information. The side that appeared dominant was given an opportunity and could not use it. What happens after that deserves closer attention than the excitement of the original push. The difficulty is deciding in advance what evidence will count as genuine failure and what will be dismissed as ordinary fluctuation. Without a firm basis for that judgment, conviction can quietly rewrite the standard, and that leads to the next discipline. Conviction feels strongest when the market is still uncertain. The empty spaces invite imagination, and imagination can complete a pattern before price has done the work. You may feel prepared because your explanation is detailed, but detail is not the same as evidence. A condition is different. It does not describe what you hope the market will become. It states what must be observable before a decision is justified. Conviction lives inside the trader. A condition must exist outside the trader, where it can be seen and checked. This distinction matters because feelings have no fixed measurement. You can be very confident today and even more confident tomorrow without anything meaningful changing on the chart. A condition cannot strengthen itself through repetition. It is either present, absent, or still developing. Useful conditions are precise enough to answer without debate. The market looks strong is not a condition. Price closes above a defined range, while the related group also advances, can be examined. The purpose of precision is not to predict perfectly. It is to prevent mood from becoming evidence. Conditions also create order among observations. A market may display one attractive feature while lacking two essential ones. Without a clear standard, the appealing feature receives too much weight. With a standard, partial evidence remains partial. One satisfied requirement cannot silently stand in for the rest. Imagine you are studying a stock that has spent several weeks moving sideways after a decline. You believe accumulation may be taking place. That belief is only a working idea. You might require the stock to stop making lower lows, recover a defined area, and show strength alongside its industry group. Until those elements appear, the explanation has not become actionable. The number of conditions should remain limited. A long checklist can create the appearance of discipline while hiding confusion. If 12 signals are required, some will usually conflict, and you will be free to emphasize whichever ones support the decision you already prefer. Each condition should have a clear purpose and a direct connection to the setup. It is also useful to separate essential conditions from supporting details. Essential conditions determine whether the opportunity qualifies at all. Supporting details may improve its quality, but they cannot rescue a setup that lacks its foundation. This prevents a minor positive feature from excusing a major absence. Write the requirements before the market becomes active. Use plain statements that can be answered with yes or no. Avoid words such as probably, nearly, and good enough. Flexible language gives conviction room to negotiate. After the decision, judge the process by the standard that existed beforehand. A profitable outcome does not prove that missing conditions were unnecessary. An unprofitable outcome does not prove that sound conditions were useless. One outcome reflects uncertainty. Repeated respect for a clear standard reflects discipline. The real test comes when your conditions are almost, but not quite present. That is when the market begins moving, the opportunity feels close, and the urge to act starts altering your sense of time. And an early entry often feels intelligent because it appears to secure an advantage before the crowd arrives. The price is closer, the opportunity seems larger, and the trader feels prepared rather than late. But there is a quiet difference between anticipating a move and entering simply because you can no longer tolerate watching it form. Impatience rarely introduces itself as impatience. It speaks in practical language. You tell yourself that you are improving the price, getting a head start, or avoiding the chance of being left behind. The reasoning sounds efficient, but the timing has shifted from a market event to an internal urge. That shift carries a cost. Before a setup is mature, price often remains inside an unresolved area where movement has little directional meaning. By entering there, you expose yourself to fluctuations that were never part of the intended move. The market is still deciding, while your position already requires an answer. Time spent inside that uncertainty is not always harmless. Repeated movement around your entry can wear down judgment. A normal fluctuation begins to feel important because money is involved. By the time the meaningful move arrives, you may be tired, distracted, or no longer positioned to act clearly. Long observation can create another form of pressure. After studying a market for hours or days, you begin to feel that the effort should produce a trade. Action becomes a way to justify the attention already spent. But the market does not compensate you for preparation by offering an immediate opportunity. Memory can accelerate the same mistake. A recent trade may have moved without you, leaving a strong impression. When a similar shape appears, you act sooner to prevent the same discomfort. The present entry is then being timed by an old missed opportunity rather than by the current market. Not every anticipatory entry is impatient. A tested method may deliberately enter before broad confirmation because its rules define that moment precisely. The distinction is whether the earlier entry was part of the method before the setup appeared. If the rule changes while you are watching the price, urgency has probably entered the decision. You can expose this habit by comparing two timestamps, the moment your planned entry event occurred and the moment you actually entered. Then record why you acted when you did. If the explanation contains phrases such as, "It was getting close," "I did not want to miss it," or "The price looked good enough," the gap was filled by expectation rather than a completed event. A useful safeguard is to define the exact action that transfers the setup from observation to execution. Place an alert near that point, but let the market cross the final distance without assistance from your imagination. The alert prepares your attention. It does not authorize the trade. Ask yourself one direct question before entering: what happened in the market during the last few moments that was not true earlier? If nothing material changed, then the opportunity did not become more developed. Only your discomfort became stronger. Yet proper timing does not make a trade immune to contradiction. Even after a legitimate entry, the market may produce information that weakens the original case. Whether you treat that information as guidance or as a personal challenge leads into the next discipline. The market can reject your premise without making any judgment about you. Yet the moment price contradicts an idea, the response often feels personal. Attention shifts from understanding what changed to defending the decision that was already made. A useful message is then received as an insult. Invalidation has a precise meaning. It is not any movement against your position, and it is not simply the arrival of discomfort. It is the loss of a fact, relationship, or behavior on which the trade depends. When that foundation disappears, the original reason for participation no longer exists in the same form. Suppose a trade is based on the expectation that demand will continue defending a defined area. Price moving toward that area is not invalidation. The premise is being tested. Price moving decisively through it, remaining below it, and attracting no meaningful response from buyers changes the premise itself. The issue is not that the position is losing. The expected source of support is absent. This distinction prevents every fluctuation from carrying equal importance. Some adverse movement belongs to the normal movement of the instrument. Other movement removes the very feature that gave the trade its logic. If you do not know which feature matters most, you cannot tell the difference between noise and structural change. An invalidation point should therefore come from the premise, not from an arbitrary amount of pain. A financial stop may be placed for practical loss control, but the intellectual boundary answers a different question. At what point is the original explanation no longer supported? Confusing these two boundaries leaves you uncertain about what the market has actually communicated. The personal reaction begins with language. My trade failed. Easily becomes, I failed. Once those statements are joined, accepting new information threatens self-respect. The mind then searches for a second explanation, not because it is stronger, but because it allows the position to remain connected to your identity. This creates thesis drift. A short-term continuation trade becomes a long-term investment. A relative strength idea becomes a value argument. A technical position becomes a belief about future industry growth. Each new explanation may sound reasonable alone, but none was responsible for the original entry. To expose the drift, write one sentence before participating. This trade exists because. Then write a second. That reason no longer applies if. The two statements should use the same logic. If the first depends on support holding, the second should identify what would demonstrate its loss. Unrelated explanations should not be allowed to replace it. When invalidation appears, describe the change without judgment. Record what was present before, what is absent now, and which part of the premise depended upon it. Neutral language keeps the event analytical. It allows you to remove an idea without turning the removal into a verdict on your ability. A later opportunity in the same market should be treated as a new case. It may resemble the old trade, but it must stand on current evidence. Reusing the abandoned thesis merely preserves emotional continuity where analytical continuity no longer exists. But when a trader refuses to let invalidation close the argument, another force begins taking control. Confidence starts influencing exposure, and the amount placed at risk begins to reflect certainty rather than uncertainty. The trade that feels safest is often the one that receives the least careful risk treatment. Exposure grows, safeguards shrink, and several related positions begin to look like separate opportunities. The danger does not appear larger because certainty has made the unfavorable outcome seem remote. Certainty distorts risk by narrowing the future. Instead of seeing several possible paths, you begin seeing one main path with minor interruptions. Events outside that path receive little practical weight, so the position is built for the expected outcome rather than for the range of outcomes the market can produce. A thesis can eventually prove accurate and still cause serious damage along the way. Price may travel sharply against the position before turning. Liquidity may disappear when an exit is needed. An overnight gap may pass the intended exit level. Direction alone does not determine survival. The path matters. This is why position size should not function as a reward for confidence. Confidence is an estimate produced by analysis. Risk capacity is a financial limit. When the two are joined, stronger belief automatically creates larger exposure, even though belief does not reduce volatility, improve liquidity, or control unexpected events. Concentration can also hide behind certainty. You may hold several different symbols and believe the account is diversified. But if each position depends on the same interest, rate move, sector theme, currency trend, or market mood, they may respond as one trade under pressure. Different names do not guarantee different risks. The same problem appears with leverage. Borrowed exposure makes small forecast errors more expensive and reduces the time available for an idea to develop. It can turn ordinary volatility into forced action. No level of confidence changes that arithmetic, and trading capital should remain within limits that do not endanger essential financial obligations. A disciplined risk framework begins before enthusiasm rises. Set the maximum exposure allowed to one idea, one group of related ideas, and the account as a whole. These boundaries should come from loss tolerance and market characteristics, not from how persuasive a particular setup feels. Then examine the position under less favorable circumstances. What happens if volatility expands suddenly? What if related holdings decline together? What if the market opens beyond the planned exit? What if the available liquidity is thinner than expected? The purpose is not to imagine disaster for its own sake. It is to discover whether the position depends on everything proceeding normally. Keep the forecast and the exposure calculation separate. One part of the record can explain why the opportunity appears favorable.